I'm your host, John Sleeting, and today I'm joined by Hunter Sims.
So there's consistent innovation that is and will continue to happen within what we kind of define the incumbent financial system. But increasingly, and I think particularly increasingly since beginning of the internet, right, in terms of its commercial use cases in the 90s, there's innovative business models, even asset classes that have emerged over time.
And so everyone, as you think about your business, think about yourself as the incumbent and how do you replace yourself? That's from where innovation is going to be driven. And that's what we're talking about now as we get into this. Hello, and welcome to Clear Conversations, the Entrepreneurial Legacies series. I'm your host, John Sleeting, and today I'm joined by Hunter Sims. But before I share an introduction on Hunter, I do want to look back at our last 5 episodes that wrapped up our mergers and acquisitions series. The M&A series was so positively received that we're actually going to have a live event coming up on Thursday, September 25th at the Medina Country Club, host of the 2026 President's Cup. We will not be golfing that day, but we'll be in the Medina Ballroom. And we'll be discussing mergers and acquisitions. We have individuals flying in from across the country that will be participating in the conversation, in dialogue regarding the process and demystifying the process, walking through a buyer's perspective, discussing the human capital components, and really this breadth of resources that's going to be in the room, as well as networking. The target audience is for individuals with the enterprise value of their companies being 30 to 300 million. As it fits into their philanthropic and their estate strategies, a lot of the things that we speak about on this podcast series. So that's coming up Thursday, September 25th. If you go to the ccpwealth.com website and you go to events and upcoming events, you can find the registration link, more information about that. Again, Thursday, September 25th from 3 to 6 p.m. at Medina on succession and exit planning strategies. We hope you can join us there. Now, this episode, coming off of that 5-part series, is a little different. As a matter of fact, it's very different. We're going to go much deeper into this subject of what is crypto, what is decentralized finance, what is blockchain technologies, how do I think about tokenization, all of these subject matters. And my guest today is Hunter Sims. Hunter is the co-executive director for the Center for Alternative Finance from the University of Cambridge in Cambridge, England. He's here as a guest stateside, so we're going to be in the studio together, and he'll share his disclaimers because this is, again, a unique subject that is meant to be educational. It is not meant as advice in terms of here's what you need to do within the crypto world. As you know, and listeners from a long time, we absolutely believe in innovation, disruptive technology, those areas that create growth in our society, in our country, for our world, to make the world a better place. Those are good capital allocation decisions. Those are good investments long-term as we think about it. But that's not what this is. This is not an investment discussion on the subject. It's just to bring all of our understanding up a little bit more on a subject matter that can be very confusing, very misleading, very misunderstood, and you really need to still take a fundamental approach to what this is all about in the way that you think about how you operate in the world. So it's with great delight that I have Hunter join me here. He is an alumnus of the University of Cambridge, where he received his MBA, his undergraduate from Taylor University. You'll hear us joke about his lack of an accent still being stateside, although he's been in England now for in excess of 7 years total. So with that, I want to get into this conversation. So Hunter, thank you so much for carving out the time while you're stateside, visiting from England and being here to come by the studio and have this conversation regarding what is acknowledged right now as a very complex subject matter. So first of all, thank you for being here. As we get started and we're going into this information, let's have listeners get to know who is Hunter Sims. They're going to be disappointed that you don't have a British accent, right? So as we start out, a little bit of your background and coming into where you're at today.
Yeah, absolutely. So, yes, I don't have the British accent, so it's good to get the disappointment out of the way at the outset. So I'm actually born and raised in Indiana, so not far from Chicago. I started my career in corporate banking, commercial banking out of Indianapolis, did some work in the States, and by way of a series of different events, found my way into East Africa, actually working in Kigali, in Rwanda, at a microfinance institution, helping facilitate a credit turnaround plan there. So sitting in the operator seat as the head of credit there, while also going through a digital transformation of sort of lending practices within the bank. And that's really how I first got plugged into sort of the financial technology or fintech space, sitting in the operator seat.
So you grew up in Indiana, you undergrad, also in Indiana, Taylor University.
Yep, that's right.
A couple years, 2-3 years in commercial banking there, then end up in Rwanda. Not the non-traditional path, right? So maybe a lot of today's conversation will be the non-traditional, or we'll come up with a title that way. So you end up in Rwanda, and you were there for how long? 12 months?
There for about a year. Yep,
okay.
That's right.
And then, so during the 12 months, you went from Rwanda. So how'd you go from Rwanda then up to England?
Yep. So I was always interested in doing an MBA program. Prior to being in Rwanda, I was exclusively looking at US-based schools. There's some great MBA programs in the States. But as part of being outside of the States and being interested in some of the different sort of perspectives and opportunities that sit outside of the States as well, ended up applying to the University of Cambridge for the Judge Business School MBA. It's very well regarded in terms of international standings, but also the big draw for me is just how diverse the representation of the class is. It's a smaller class size than most top tier U.S. Universities, but it's also incredibly diverse in terms of students from all over the world: East Asia, Sub-Saharan Africa, the U.S., Canada, Latin America, Europe, of course, and the U.K. So that was the draw.
So Cambridge, I mean, Cambridge is a global institution, right? And a lot of people think about Cambridge. At the same time, they're thinking about Oxford and another, global institution. They truly are that for the draw of individuals. Help listeners understand a little bit more of the context around Cambridge University, and we'll tie this together of why I'm spending a little bit more time on it. But what is Cambridge University for listeners?
Yeah, I like, when we're talking about technology in the future, I like the idea of starting back 800 years in the past. So that's perfect. Right. So 1209 was the original founding of the University of Cambridge. So it's a little over 800 years old. It is known for many things because there's many esteemed academics, innovators, leaders that have come out of the University of Cambridge. Charles Darwin, who began his study into evolutionary processes in the University of Cambridge. John Maynard Keynes, the famous economist, and who still, I think, drives a lot of economic theory.
Good or bad, right?
yeah, exactly. That's right. Exactly. Isaac Newton, who I think a lesser well-known job that he had was actually running the treasury for the UK, among also discovering or uncovering gravity, theoretical basis. Yeah, just little things like this. So it's always been known as a university that leads and drives on innovation. It consists of 31 different colleges of all sorts of different specializations, but all within a very tight cluster within the university, within the city. So it's kind of a city that is the university, and these different colleges, they're called colleges, which might be confusing because in the States that would be independent, kind of like a university, but actually these...
It's more of like a super fraternity or super sorority in terms of people coming together. In some ways, that's the way the college
that's right.
Set up. I liken it, again, for good or bad, those that watch Harry Potter, I'm like, think about Harry Potter and think about the different groups of kids that were in Harry Potter. Right. Those are colleges.
That's right.
I mean, if you think about Hogwarts, think Cambridge University.
Yeah, I mean, I unashamedly use that reference. So absolutely, yeah, the Gryffindor and the Ravenclaw, but it's all Hogwarts. Yeah, exactly, that's right.
And then the academic approach is broken. How's that set up then within the university structure?
Yeah, so there's independent disciplines within the university. So they're broken up by academic specialization. So for instance, there's humanities, physical sciences, Technology is one of the schools as well. The business school actually sits under the School of Technology as a department.
Which is going to be another interesting connection as we go through today's conversation.
Yeah, that's right. So it sits right across the street from the Department of Engineering as well. So that's how it's constructed effectively.
Okay. And so you do your MBA, so part of the business school now under the umbrella of technology, but you're still there, right? And you're still tied into the university. You're not here today in this conversation on behalf of the university, but you do work for the university as well as certain commercial enterprises that get launched. Can you share a little bit more of like that setup and as you're speaking, how listeners should be hearing from you and whatever that may mean to make sure that we all stay out of trouble? Because I'm going to have some compliance disclaimers on this conversation today as well.
Yeah, absolutely. So I'll have all my disclaimers as well right at the outset, which is it's a conversation. We're exploring a fast-moving and innovative space. Any conversation we have isn't necessarily a representation of where I'm from and where I work and the work I do. But in terms of my day-to-day, after the MBA, although I had not planned on staying in Cambridge, became fascinated with the work of a research center out of the business school called the Cambridge Center for Alternative Finance, which was co-founded by three individuals, Professor Raghavendra Rao, Professor Wardrop, and my now co-director, or he's the executive director of the center, Brian Zhang, who started this research center that was focused on discovering and understanding innovation that occurs from outside of the incumbent financial system. So there's consistent innovation that is and will continue to happen within what we kind of define the incumbent financial system. But increasingly, and I think particularly increasingly since maybe the beginning of the internet, right, in terms of its commercial use cases in the 90s, there's innovative business models, even asset classes that have emerged over time. And they were and continue to be really interested in the impact that has for consumers, for institutions, for policymakers and regulators. And so now we're actually one of the biggest research centers out of the university, the largest out of the business school. And I work in our strategy, business development, and leadership team there within the center.
So a whole lot going on there. So the Center for Alternative Finance, a lot of times when people at least think about alternative finance or alternatives, they think about alternative investments being private equity, private real estate, private credit, venture capital, et cetera. That's not what we're talking about. So this whole definition regarding alternative being alternative to the incumbent. So a lot of today's conversation is going to be going through definitions to try to get our head around and to help listeners think about what is this crypto decentralized finance? What is it really? And what are some of the nomenclature? Given my military background, I know when we used to talk about military items, actions, acronyms that we would get into, all of that then would be driven in such a way that people around us would have no idea what we're talking about. And my fear is that there's a lot of that. That's what my hope is from today's conversation, is to bring forward a bit more plain language, albeit difficult, a bit more plain language regarding what are some of these concepts. So first, what is the incumbent financial system? How would you define incumbency?
Yeah, no, that's a great question, and hold me honest on using language that does demystify what I think is sometimes maybe even unnecessarily opaque space, and some of it is opaque because innovation can be messy, and definitions come as they go. When I think about the incumbent financial system, I think of regulated financial institutions, so that sit within a regulatory regime, a perimeter within a regulatory jurisdiction, who offer financial services and products to businesses as well as consumers. So some exclusively to businesses, some exclusively to consumers, but that's the sort of operating space I think of. As a proxy, some blue chip organizations, JP Morgan Bank, Morgan Stanley, State Street, all different kinds of incumbent financial institutions. I would.
You've long said, we've known each other a long time. But you've long said, we need banking, we just don't need banks, right? So we need banking, we just don't need banks. What do you mean we just don't need banks?
Yeah, I wish I could remember who actually came up with that, but it wasn't me. Okay. So I'll have to remember to credit who it was. But yeah, I think I think banks have a really negative reputation in sort of the consumer zeitgeist for whatever reason. Mm-hmm. I think some of that is just people don't understand how banks operate, what banks do. Things like 2008 financial crisis leads a lot of people with a bad taste in their mouth, it seems, around feeling misled, these other components. Regardless, banks are one form of a function to deliver a product and a service for individuals or businesses that need financing, that need a place to store money safely, that need a way to transact between one entity and another entity. These are the core elements of effectively the entire financial industry. And then over time, for lots of credible reasons, institutions form, reform, shift in banking in the States, mergers and acquisitions, mega mergers and acquisitions, massive institutions. These exist for reasons, but actually when I think about the world needs banking, I'm thinking from first principles around the products and services that are required or have the opportunity to bring value for clients.
Right. So the products and services of banking, the interchange that takes place. There's also that role of the trusted intermediary, right? That a banking institution can bring, but that's part of that incumbent role. And as the world changes, as technology changes, as we think about, and I try to keep drawing upon all these different examples that we look around that sometimes we can try to get the handles of. But if we talk about the driverless taxis, right? The service is the car getting you from one location to the other, not the person that's delivering that car, right? And all of a sudden now the car is that without the person involved, without that third-party intermediary of a taxi driver getting you from location A to B. You still need to get from A to B. You still need banking services in that process. You just don't need the driver as the intermediary that's getting you from point A to B. So the incumbency is moving from, taxis as a simple case, to technology evolving in such a way that driver is no longer needed to get you from A to B. Is that, again, I'm making some of this stuff up as we go here, trying to get my own head around it at times. Is that fair? Is there another analogous example that you would have to help people understand what is incumbency versus where things are being driven to?
Yeah, I think so. What I like about that analogy is the clear emphasis around the core value proposition, getting from A to B. And I think the litmus test for innovation, from my perspective, should always be around using that analogy more safely and more efficiently getting that person from A to B. So either lower cost or faster or both, but safely from A to B. It's actually really similar to how I think about financial systems in general. Maybe through mergers and acquisitions, banking institutions are in a better place to do exactly what the mandate is from my perspective of financial system. That's great. That's fantastic. We should do that. Maybe it's not, and maybe that trusted intermediary component of how you frame this that analogy should be challenged, and it should be open to being challenged. And if there's a better and more efficient way to do the thing that a bank does in its current form and function, fantastic. That should be something that's explored.
Right.
In the exact same way, though.
Right.
Consumer, protection, downside protection, and then also capturing benefits in terms of the core value.
More safe, more secure, right? People can still get in car accidents. Yeah. Driverless cars can get in car accidents too, but as that technology continues to refine that process and its sensors and its cameras, that risk continues to get reduced, and then it's repeatable versus being subject to human error getting in between. So a little bit back to the center. So you and Brian are co-executive directors. Can you share a little bit about what Brian's work is versus your work on behalf of the center?
Yeah, absolutely. So Brian's the executive director and co-founder of the center. So he's been there since the beginning. We're actually celebrating 10 years this year. So
congratulations.
Thank you very much. The teenage years are among us very soon, hopefully. And he's many things, but one of the things that he is I think he's fantastic around identifying where innovation is going. So, identifying where the puck is moving rather than where the puck is. He's just had a really strong track record of insight of where there seems to be some degree of traction or impact in terms of where innovation is meeting finance. That's always been one of his core skills. He also then drives our research in terms of our research domains and areas of focus. I came into...
And how many researchers are at the center?
It depends on how you define researchers, but we have kind of all in, we're about 70 individuals across the world. About a fifth of our workforce is in Cambridge, another fifth in London. The rest are all over the world. So as far east as Indonesia and as far west as the US. And so, yeah, that's what Brian does in terms of driving our research agenda. I came into the center really with an operational and finance expertise in terms of the work I had been doing previously. I brought that as sort of the MBA troublemaker amongst researchers and trying to find ways to scale the impact of the work that we're doing while staying really focused on, I think, a really valuable mission, which I should have defined earlier on. But, we do work in a space that anywhere we can, if we can reduce knowledge gaps by providing better, more accurate information or into the right hands of the right person at the right time to inform evidence-based decision-making. That's kind of our core mission, right? So especially in worlds of innovation, our thesis is people with better information in their hands make better decisions, and that's better for everyone.
So who are the customers of the center, right? Who's, money that's going in for research projects, a little bit of a flavor of the kind of institutions that are coming to the center to get work done on this topic?
Yeah, so from a funder-based standpoint, we receive funding from a variety of sources across the world.
Government, non-government, commercial?
Government, non-government, commercial. So blue chip philanthropic organizations like the Gates Foundation, overseas development work. So we work in the global south with emerging markets and developing economy regulators principally. So central banks, securities commissions. A lot of that's funded by the Gates Foundation, and a lot of that's funded by the Foreign Commonwealth and Development Office, FCDO, which is kind of like the UK's version of USAID. And then we have, particularly on our digital asset type work, we have a public-private consortia of philanthropic and grant-making funders from the likes of payments processing companies like Visa and MasterCard to Fidelity, Euroclear as well, so kind of across the financial system value proposition space, and also on the public side, so BIS innovation hubs, so as part of the Bank for International Settlements, keep me honest on the acronyms.
And this is what's so interesting to me, because you talk about this alternative finance, and it's the alternative to the incumbency that's out there. And yet when you go through the names, not governments, but when you start bringing in the commercial operations that are out there, the people that are operating within banking and payments and processing and all kinds of financial technology, they're trying to figure out where the puck is going, right? They're trying to figure out what is going to displace us, which is what everyone should be doing in every business that's listening. You don't have to be operating in this particular space within financial services, technologies, crypto. If you're listening in terms of thinking about, well, what's the investment thesis here? As you're thinking about your own business, you should be thinking about who's trying to displace you, who's going to innovate and replace your incumbency, no matter what that industry is, right? We're talking about it from a financial services replacement, but every business out there is going to be disintermediated in some way, found to be more efficient. We even just did it with taxis and taxi drivers and cars. And so everyone, as you think about your business, think about yourself as the incumbent and how do you replace yourself? That's from where innovation is going to be driven. And that's what we're talking about now as we get into this. So these companies, these institutions, these countries are trying to figure out where is that, that puck going.
Yeah, that's right.
And what's going to replace the incumbent systems, whether they do it themselves or somebody else is going to come in and do it to them. So as we talk about the non-incumbent players, they're still trying to figure this out. You have other things that are evolving and taking place. And so one last item on the center itself in terms of the setup, and then I want to go deeper into this crypto, decentralized finance. What is that all about? So there's different pillars that you organize some of the research around, from regulatory to this crypto world. How would you talk about the construct of the center itself?
Yeah, that's right. So actually, really, the way that you framed trust and the importance of intermediaries, it's a big area of kind of how we think about the work that we do. So again, if our mission is to inform better decision making, kind of anyone could be a client, because everyone wants to make better decisions and everyone benefits from better information being out there. So that's true on the market side, I'm sure we'll talk a lot about some innovation that's happening in financial markets and the like, but it's also true across the aisle with the regulators, the supervisors, the policymakers who are trying to figure out what to do with this sort of space of innovation, what's changing, how are the risks changing, a lot of regulators have a dual mandate of consumer protection and growth. Okay, so how do I marry those two things together? Right. Really tough job. So when we have constructed our work, we have different work programs that basically try to address those different core needs in terms of the clients. So we have our Regulatory Innovation Hub, which is a team that does fantastic work around how regulators can innovate the work of regulating. We have a supervisory, a Sup Tech lab, our Cambridge Sup Tech lab that we run, which focuses on how technology can provide and better arm supervisors to do the work that they have in terms of their core mandate, which is an essential component of financial systems where everyone's better off. And then on the market side, we have our financial market infrastructure and innovation team, which looks at where innovation's happening across all financial markets. It's a really broad remit, but we take sort of core themes that are relevant in those kind of core themes being things like artificial intelligence, digital public infrastructure. So how is infrastructure changing the landscape for how the game is being played in private markets? And then we have our digital assets work stream. So that one's specifically focused on what's often called crypto assets as a kind of a unique set of research opportunities in terms of the work that we're doing.
And you end up having conversations with people literally all over the world, right? Not just in the centers, not just in these organizations. You've had conversations trying to explain certain topics to royalty. You've had it with earlier this year. You're in Washington, D.C. for a conference, and you were moderating a panel, and your panelist was U.S. senators and congressional representatives. You end up having conversations with people that don't know a whole lot about it. As you go through, what are some of the most common questions that come up regarding the evolution within what I'll ignorantly just broadly call crypto? When you hear that term, what's the response? What are the questions that come into play?
That's a great question. It really varies because we deal with international experts in this, and we deal with individuals who have a mandate but are also starting from kind of square one in terms of an understanding. On the sort of more kind of getting to grips with what crypto is kind of the standard question is, what is it? When you say crypto, what do you even mean?
Right.
I hear cryptocurrency, I hear Bitcoin, I hear certain words that are thrown out. Just explain what it is from kind of a core principle standpoint. And actually, in my view, for the first several years of sort of the crypto innovation cycle, I suppose, maybe as a way to frame it, I think there were really poor explanations because it was, kind of coming from a computer science background, like a really esoteric, niche community of computer scientists who spoke each other's language. But for people like you and me who don't have a deep technology background, really kind of quite hard to access cognitively. So kind of standard questions. what is crypto? Is Bitcoin good or bad? Is everything going to be crypto? Should I take my money out of the bank? I mean, you'll get all sorts of kind of questions like this that are just a reflection of people coming to terms with what this big cycle is.
So as we continue through this conversation, right, probably both have to put on this is a conversation between the two of us. It's not representing the University of Cambridge nor Clearwater Capital. Nothing that we talk about should be construed as legal, tax, financial, investment advice. We're not making any recommendations whatsoever through this conversation, and absolutely encourage people to take it in as a catalyst that's thought-provoking to explore and learn more, because this world is also moving very quickly. Anything you need to first add to add to
I'll
that?
add as well, not policymaking, regulatory, or supervisory advice.
Yes.
So we have the privilege of working with people across the aisle in many different areas. We really stay true to kind of our core mandate at the center in terms of the work we're doing to just provide evidence bases and information for decision making.
Yeah.
In this conversation, we're just having a conversation.
We're just having a conversation.
John and Hunter.
Right.
Yeah.
And when we do that and going through this conversation, right, in full disclosure for everyone, and I know I was playing a little bit like I didn't know your background to start there too, but you are my son-in-law, right, and the father of a couple of my grandchildren, and coming into this conversation. But I think listeners already have a flavor of your intelligence, right? And I know you didn't pay me to say this in terms of things. I'm pretty sure I'm buying dinner later as we go out. But proud of you, and also impressed with and your understanding of subjects that I still truly am trying to get my head around. So although I may have played a little bit dumb here in the intro piece of it, of your background, I'm not playing dumb from this point going forward. I still just have a lot of basic questions regarding, all right, where's this really going? How is this world evolving? Because it's happening so quickly. I know John Chapman, our CEO, often brings in that quote, around the world has never moved this fast and will never move this slow again. And that is no more true anywhere, except in addition to this space that we're about to speak through. So what we're even talking about now, we may have a different perspective tomorrow on, given what we're learning. There's actually an article that came out from Crypto Advisor just this morning, speaking about an individual that's very well recognized within the wealth management space, talking about how crypto, again, very broadly, so it depends how you define it and how that individual even defines it, should be a core holding. Again, this is not a recommendation for anybody, but the world's moving fast and we're all trying to get our head around it. So as we go through, when we post this, we're also going to post a handful of pages of a paper that you're putting together to coincide with this podcast episode, which is going to capture some of the things that we're speaking about, but in a little bit more of a paper form for those that want to take it in or reference it. And that'll also be on our ccpwealth.com website under Insights, so that it can be a reference. And I'm going to go to a few of the items in that paper. So if I'm looking down more than normal in a conversation, it's trying to make sure that I'm not getting tongue-tied and making sense out of some of the things that you're hitting on here. So with all of those disclaimers and precursors and caveats, we will dig in, and I'm going to go actually to your first line. The fundamentals of digital asset ecosystems. Digital assets have evolved from computational experiments into an industry moving trillions of dollars across public blockchains, decentralized finance protocols, and tokenized representation of traditional assets. All right, so a lot going on even in there in terms of, we'll come back to tokenized in a little bit, but let's go first with decentralized finance. Is this banking services without banks? What is decentralized finance?
Yeah, absolutely. And please do interrupt and kind of pull me back, because it's, first, maybe even before describing what decentralized finance is, I think a lot of what we're going to talk about is jargon that's loaded up through news articles, and I mean, myself certainly as well, getting caught up in different phraseologies and wait, what does that actually mean? And it says it here, but it says it there. What's the core definition? When I think about this type of innovation, I really try to start from a technology angle first, which is the hardest angle for me because, as I said before, I'm not a deep technologist by background. But coming at it from a technology angle helps understand kind of the core applications. So when I talk about decentralized finance, yes, there's a core ambition of decentralized finance to do sort of what the name says it's going to do, which is disintermediate these trusted, historically, intermediaries, big banks, settlement organizations, sometimes governments, through other mechanisms, through technology that solve the same problem, which is effectively trust, right? Counterparty trust, settlement trust that the money that's there today is there tomorrow. All of these are just proxies for trust. It's a big part of the value of traditional, what I'll call incumbent financial institutions, not to the exclusion of other services and benefits as well. So decentralized finance is effectively leveraging innovation in technology and computing and cryptography, so security, information sharing, to basically ask that basic question: do we need X, Y, and Z? Do I need a bank? Do I need a settlement house to do the thing that I'm trying to do? And they start with that basic question and they kind of build from there. Sometimes the answer is yes, I absolutely need it. Other times, actually, maybe I don't. And so decentralized finance is leveraging effectively programmable money, which I appreciate is kind of an opaque phrase.
And so we speak a lot about central banks, right? The Fed in the U.S., right? The Bank of England over in England, the Bank of Japan, right? These are all central banks. So centralized finance, is it almost that simple that when you think about centralized finance, think about central banking systems? But then you end up with the sovereignty overlay. You end up with that, I just named it, right? The U.S. Federal Reserve, the Bank of England's bank, the Bank of Japan. I mean, these are all country by country specific. Is that too much of a stretch to say that's the incumbent, that is the central banking system, and this is all anything that's working around the central banking system? Or is that going too far?
So I would say it's going too far. When I talk about traditional finance, which is actually even slightly different than centralized finance, unhelpfully, I know. If you're relying on the credibility of an institution to accomplish the service that you want, right? I'm sending money to you, you're sending money to me. Hopefully it's the other way around. You're sending money to me, and your bank interacts with my bank for your money to get to me. That would be an example of traditional finance, or as you framed it, centralized finance. You're trusting your bank, and you're trusting my bank, and I'm doing the same with mine and yours, for you and I to exchange funds. That's when you talk about traditional finance. That's what you think of. So if you cut that across the board and said, I'm going to throw just computer code, fully transparent, fully auditable, I can see it, you can see it, to do that exact same thing, that would be an example of leveraging decentralized finance. So I don't need to trust your bank. You don't need to trust my bank. You don't even need to trust me.
Right.
You're just trusting effectively executable computer code. Again, I appreciate it's kind of opaque, but thinking about where can trust be disintermediated at an institutional level. So not just necessarily central banks, but any sort of institution, financial institution.
And so let's bring that into our world from an aspect of Schwab is our primary custodian, right? Yep. So we as an independent registered investment advisory firm, we have an arm's length back with Schwab as a custodian. They're giving a full accounting to our clients and the activities of the assets we're managing for them. And when they give that reporting, or they're processing any money movements for us, or security settlements, when we're buying a stock, an ETF, an option, whatever it is, they're running through that process. They're still an intermediary at that point in time in terms of executing that on behalf. And so we have this settlement process taking place. Is that all considered traditional finance in this world?
Yes, I think so. I think when we talk about decentralized finance, from when I talk about, I suppose, decentralized finance, I'm only thinking about where computer code can do the job of something that exists as a trust-based intermediary. So you trust Schwab because Schwab has a great reputation, fantastic track record, good history, both on the market side, but also with regulatory considerations, conservative and thoughtful safeguardings in place. If Schwab didn't need to exist, which I'm not suggesting in this call, we're not getting into tricky territory here. If Schwab didn't need to exist because there was computer code that effectively gave you the information that you needed as an RIA to do the thing that you do, then that would be a form of disintermediation through technology, decentralized finance, kind of broad umbrella in terms of a definition there.
Okay. And it's over time, because one of the things, a client would call up and saying, I'm, buying a new car, I'm buying a new boat, I'm buying a whatever, can you wire funds? Then you have to go through a settlement process, right? You liquidate a securities, you raise the cash, it takes a little bit of time. And that window continues to get squeezed down.
That's right.
To be competitive in order to have the cash flow moving. How fast is the settlement process when it happens between two parties without a centralized intermediary? That becomes instantaneous?
Yeah, so that would be effectively called atomic settlement, which is, I think, sort of a bit of a jargon word, but effectively saying instantaneous. So T+0.
Atomic settlement.
At the intrasecond
So I just learned
level.
something else here.
Yeah, that's right, exactly.
So we're in pursuit of atomic settlement.
Yeah, that's right. We're not splitting atoms, but we're getting to the atomic level. So yeah, that's right.
And so they're going to compress that down. Mm-hmm. At a point in time, take Schwab. It's not about Schwab. It's not about the banks then. Can these things coexist, or does everything just evolve over time to become decentralized finance? Should they coexist?
I love that question. Yeah, I think they do coexist now. So even 5 years ago, that would have been a question that I think was a credible research thought experiment. Can these actually coexist? Are these going to be two totally separate, effectively, economies, right? The traditional or fiat economy and the crypto economy, and they'll never interact. 7, 8 years ago, that would have been a really genuinely credible question because it wasn't clear. There's now been this massive bridging function of quote unquote traditional institutions leaning into the digital asset space, and also digital assets builders, everything from public blockchains, like most people have probably heard of Ethereum, that are creating effectively on their public blockchain enterprise grade solutions for financial institutions, kind of reaching across the aisle the other way. So I think they can coexist. From my perspective, to really kind of reduce it to simplicity, a lot of this game is about efficiency, cost, and protection. That was true before crypto existed, right? So it was T+30 before, it took 30 days to settle years and years ago. Now it takes 3, sometimes same day settlement just through anything but blockchain or crypto assets. So that's just a continuation effectively of that.
So if we go back, because not everyone, there's a lot of people that have heard of Ethereum, right? But a lot of people haven't. So we'll come back to what is Ethereum in a moment. If we go back to the genesis of however you from a moment of creation or a big bang or how that's getting defined, right? What is again called ground zero, the starting point that lit the fuse of all of this?
So I think almost everyone would say, and I'll join everyone in saying it, in this space, that Bitcoin was probably the starting gun for this innovation surge in crypto assets.
Okay, so let's talk Bitcoin then.
Yeah, there were earlier attempts, but Bitcoin was the first time that there was a cryptographic solution that then eventually had some monetary value, which is why I would start that as kind of the genesis point.
Okay.
So that was in, I think it was late 2008 when the original white paper was published. This is effectively just a description of what the Bitcoin protocol is. So the core system and function of what the Bitcoin protocol is. It was then a couple of years before it had any priced market value. So it existed as, I called it in this paper, right, a computer science experiment, right, because it didn't have any commercial value for a while, right? So computer scientists who were interested in cryptography, security, systems were mining Bitcoin, running tests, making their own different types of protocols, but it didn't touch the real world.
And this is all slightly post-financial crisis, right? The global financial crisis, so we're talking 2008, 9, 10, somewhere in there.
That's right.
And this coming together. So in the chicken and the egg, right? So I'm going to get real, in the chicken and the egg, did it stem from distrust of the banking system that came out of the global financial crisis? was that just an accelerant for some of this thought work that was taking place, or it's just unknown? It's like it happened. Could be coincidence more than causation, but it happened around the same time.
Yeah. So there's something called the cypherpunk movement, which was effectively computer scientists who were taking a view that technology could break a bad system, which engendered distrust in financial systems. So 2008 was a massive accelerant for that in that movement.
Okay.
So when Bitcoin kind of came into being in that 2008 and beyond era, that was definitely, there's good documentation that was a part of the kind of thinking of why am I even working on this to begin with from some of the early Bitcoin developers. So yes, in short. Now, it's matured massively since, and we can go into some of that as well, kind of the idealism of the early days versus what the crypto asset, digital asset industry seems to be now today.
So what is a Bitcoin then?
So Bitcoin's two things. One, it's the protocol, which is effectively an information sharing and security system. Picture effectively ICT. It's information technology infrastructure. And then a Bitcoin is effectively lines of computer code that compile into a discrete virtual, I'll use the word virtual to avoid the word crypto, asset that has a couple of core principles, one of them being only one person can have, or one wallet, I suppose, can have access to that Bitcoin, that virtual asset at any given point in time. And then that is secured through a security apparatus, which is effectively called Bitcoin mining, to ensure that can and will always be valuable in whatever form and function the entire network is deemed to be
maintaining its
valuable.
Uniqueness.
Yeah, that's right. Exactly.
And so that continues to evolve. Those continue to be mined so that there's these codes that are getting created. And effectively, that code is ascribed value because somebody says it's a value, right?
Yeah.
So somebody's got a code. And I know I'm way oversimplifying it, but
no, it is.
But you're taking the code, you're saying that's a unique code, and that code has got some value to it, and the value of that code is what somebody else is worth believing that they would pay for it. That's effectively all it is. It's not backed by anything. It doesn't represent another asset class. It doesn't. That's where tokenization comes in. So again, we'll come back to that. But you end up with this code that somebody says it's got value. Why would it have value just to own a code?
Yeah, absolutely. So there's many different ways to value Bitcoin, and they, in my view, run the gamut of kind of, whoa, that's a really unique and maybe not well-founded view to, okay, that seems to bear some degree of credibility based on performance. But from my perspective, the core answer, particularly in the early days, is it only has value. It's only worth what someone's willing to pay for, which is, I think, that's the market talking, I suppose.
Right.
So when it's trading at a few cents, it's effectively an illiquid asset that has no market value at all, or before then zero market value. Why in the early days of why it was viewed to have value is there's a big emphasis on its limited supply. So there will only ever be 21 million Bitcoins ever in production in the world, and it was kind of described as having a deflationary effect, right? So actually that limited supply and the theory of consistent or increasing demand would create and maintain value over time. So as soon as you have a market price at all, that will hold some degree of value. Another way of valuing Bitcoin is rather than the cost someone's willing to pay for it, is the cost it takes to create it, because no one's going to create a Bitcoin if it's worth less than what it costs to create. So that's kind of a pricing floor around thinking about the value of Bitcoin. So the simplest way to think about mining a Bitcoin or creating a Bitcoin is paying for a lot of electricity through semiconductors, through computer chips. And whatever amounts you're willing to pay for the electricity and the hardware, the semiconductors, that's a value price that you can draw. And then there's more, I would say, kind of commercial comps for pricing Bitcoin. So there's a theory called Metcalfe's law, which is that the value of a network is worth, I think it's the square of the number of active participants in that network. So you can get to a valuation of the entire system, right? So the whole protocol. So the value of every Bitcoin, you just take that number and divide it by the number of Bitcoins in circulation. There's more and more of these types of kind of valuation, but fundamentally it's worth what people are willing to buy.
And then what's the, when we speak of gold sometimes, there's gold, and it kind of has the value of gold, and that's, this year has been up significantly versus the debasing and the value dropping of the US dollar. So when you look at that, but there's also commercial application to it, right? And there's also the demand side of it, the supply and demand in terms of how that plays into it.
Yep.
What's the commercial application corollary versus it just being, here's what I pay for an ounce of gold, okay, that makes sense. But then here's where I'm going to use gold for commercial purposes. What's the commercial application and usability right now of Bitcoin in particular?
Yeah, so there's a lot of people who have varying views on this. A core, really since the beginning of Bitcoin, a core view of the commercial application is as a payment settlement network. That's what it was designed for initially. So there's two ways that Bitcoin miners, the people who effectively fund the security of the protocol, get compensated because they're not doing it for free. One is they get effectively a block reward of the value of the Bitcoin that was actually mined. So there's a new Bitcoin in the world, they'll get the value of that new Bitcoin that was mined. The second is actually a transaction fee, so a percentage transaction fee of every transaction that's made on the network. So you can think of it just like any other sort of payments network. There's a fee associated with that. That's the underlying economic value over and above, similar to gold. It's the underlying economic value over and above the investment case or thesis. It's a little bit unproven, the transaction fee as revenue as a proxy for value, because the Bitcoin produced during the mining process is much more significant than the transaction fee. I don't know the exact percentage, but 95% of that is just the new Bitcoin created versus the actual transaction fee in terms of the reward. But there is economic, there's underlying value created, revenue created.
So where's Ethereum come in then too? So now I've got my Bitcoin. What's Ethereum about?
So Ethereum, so as I described, Bitcoin is two things, right? One is the protocol, the other is the actual asset, the Bitcoin itself. Ethereum exists in the same way. It's a completely different protocol with different design specs and kind of rules of the game in terms of how Ethereum, the protocol, works. One of the big innovation drivers for Ethereum beyond Bitcoin, so Bitcoin predates Ethereum by about 5 years. I think Ethereum might have just turned 10 recently, and this month even, or maybe last month, 10 years old. But the big kind of value driver there was that you could more easily program applications on top of the protocol. So when we talk about DeFi, Ethereum is one of it's the biggest protocol level. So when you think about the kind of the room where this DeFi thing is happening, Ethereum is the biggest room right now in terms of market commercial traction, and it's through that sort of the ability to build applications. So it's really, really hard to take the example that I gave earlier. It's really, really hard to leverage decentralized finance and market making, for instance, on Bitcoin protocol, just in the way that computer code and design is established. It wasn't created for that purpose. It's much easier in Ethereum. So
how many of these protocols do we need then?
It's a great question. If you ask me in 30 years, I'll have a much better answer. My answer right now is one, simply we don't know. I would say I would ask the same question in terms of how many financial institutions do we need, just as a thought experiment of, do we need one that's just really, really good, that's run by the government? Do we need 100 million with perfect competition in the market that's pricing the best possible value to the consumer or the end client? In terms of market traction right now, there's a half dozen to a dozen core protocols that have really significant traction.
Is it the protocol that is a process versus it being the coin that's not a currency, but it's considered a currency, right? I mean, is it is it about having the room and having the highway system for people to move their cars down versus it being the cars themselves, so to speak?
Yeah, I think that's a good way of thinking of it. The protocol is the infrastructure, it's the roads, and then the cars would be the applications, the different uses of the roads. The coin, I don't know, it's not I'm probably breaking the analogy at this point, but it's the toll road to use the highway. So the cars that are running down the highway, the applications that are using the protocol, are paying fees to the, it's not that bad, I guess. Maybe it's a new analogy. Here we go. Yeah. Toll road system, right, to pay for the underlying value of the infrastructure.
And so and again, not a recommendation on investment, but a lot of listeners are thinking, okay, what's the investment thesis behind all of this? If Bitcoin we talked about was supply and demand aspect to it, and just some people would say it's limited supply, so there's going to be value there. And
right.
What is a piece of art from Renoir or Monet worth to somebody? It's what they're going to be willing to pay for it.
Right.
Some people would argue it's the greater fool theory, that somebody else is going to pay more for it than what I paid, and they're counting on that. But that always ends badly. So where's the value then in this entire ecosystem of if you got your Bitcoin, or is it on the toll road that you own the toll road? How do you participate in that? Is it the exchanges that people are trading coins in different ways? Where's the value component of where this builds in the future?
Yeah, good question. Complex question. Three kind of thoughts. At the core protocol level, adoption's king. Adoption in terms of ownership and utilization of the core asset, so Bitcoin or ETH in terms of Ethereum, historically provides strong returns. So I don't know that it's a winner take all market. There's no real evidence that it is, but there is evidence that protocols with good traction have defensibility in terms of pricing. That's just historically true. Not to say it's true in the future. The
protocol versus the coin, and I say that are those two different things?
Yeah. So the coin is the proxy for the value of the protocol.
Okay.
So
okay.
Easiest way to think about it. It's a good clarification. So that's one. You say, where's the value? Where the most activity is happening, it's kind of that Metcalfe's law that I made the case for earlier. That I described earlier. The more users that are actively using the core protocol, the highway, the more valuable that highway is. And the way to have exposure to that is through the coin. The second, I suppose, area, from my perspective, would be in a broader sense, and kind of this is where we're getting to really kind of where a lot of innovation is happening. There's a lot of unknowns. There's a lot of risk. Kind of deep crypto space where computer code's competing with computer code to bring the best solution to the market. In that space, I think there's value creation opportunity in the same way that when the internet came about and you can move information in a way that you couldn't move information before, there's going to be big winners and there's going to be lots of losers, right? The 2000 bust. There's going to be lots of losers, but there's going to be big winners. So there's firms that are operating in this space that are going to be, in my view, sort of crypto equivalent of the big 10 tech firms today in terms of the internet era. Maybe those firms will be those same 10 tech firms. Maybe it'll be a bank. Maybe it'll be a completely new type of institution. I think history favors agility at points of inflections of innovation. You've seen that in your career. I think there's a case to be made for that. The way to get financial exposure to that would be kind of in a unique way, in a not public markets way sometimes, actually just completely by having token exposure. So a lot of those really kind of non-incumbent firms, don't think of the big tech firms, don't think about the big banks, think about, I won't name any firms specifically because it's not investment advice, but think about startups that rather than going and doing a capital raise with a VC, do a coin issuance where they'll say, we're going to issue X number of coins, and we're going to, and the market will price that number of coins we issue. If you want to have those coins, great. If we make it big, there's going to be a commercial opportunity. That's the really kind of esoteric, deep native crypto space. The last one is kind of back to what we were talking about before, this bridge that's happening between traditional finance and digital assets. There's lots of commercial opportunity in terms of value creation in some of the institutions that are leaning in to this space where they are publicly listed companies. I think you said it well, that you either get disrupted or you disrupt yourself, and anyone who's a business owner should be thinking about exactly that question. And I think the leadership of the institutions that are in public markets and private markets now that are thinking that way have a great opportunity to create value.
So then let's take those three. Where does tokenization fit in?
Yeah, so tokenization, which in terms of just a really quick definition, would be a digital representation of sometimes they're called real world assets or a financial asset. So rather than a bank deposit, a tokenized bank deposit is effectively just creating a digital representation, a token, a virtual asset that's sole purpose is to represent
a share. And real estate has actually been the best example that I've heard of it, right? So if you have a building, that building could be represented by 1,000 tokens.
That's right. So you can have 1,000 owners of one building, or 1,000 owners of 1,000th of a building. Right?
And so play that forward then too. So people are in buildings, right? Or maybe they're in their car right now, or they're in a building or a home or whatever. So they can relate to the real estate.
Yeah.
But now when they think about having 1,000th of a share, they think about legal documents. Okay, I'm a limited partner. I signed the legal documents. I now have that share. Where does the token replace that document set or that legal standing?
Yeah, so tokenization of real world assets like real estate is a problem that's been worked on for a long time, at least 8 years from my knowledge, which probably means 30 years.
Right. Which is kind of funny, right? That's a long time, about
exactly.
8 years.
8 years, yeah, exactly, that's right. One of the core issues with tokenization of real assets, like a real estate, like a house, let's just take the house as the example, is it's all well and good to have a digital representation of a house, but you need to have a legal and regulatory framework that exists in the same way, where that token will hold the same characteristics as the title and deed of the house that you have, for instance. So without that, it's a little bit of a kind of a chicken and egg, I suppose, right? You have the technology ability, but you don't have the legal regulatory framework to leverage the benefits of it. There might be a whole lot of good reasons for that, to be clear. There's been more traction in areas where there is a wider regulatory framework for tokenization or kind of application of crypto assets in general. This year's been a big year for that, particularly in kind of financial settlement assets. So for a long time, central banks have been looking at central bank digital currencies. So how do I issue money that's digitally native rather than in the way that I do now? Stablecoins is another core area. So it's private firms.
So we'll come back to stablecoins in a second. As we're staying on tokenization for a moment, but if you tokenize, if you take an illiquid asset, piece of real estate, and you tokenize it, you can now produce liquidity associated with it, which could be more open market, secondary market type trading that could take place through the tokens.
That's right.
On an illiquid asset, like people think about the stock market or the bond market right now.
Yeah.
In terms of how public assets get traded, but it's not a public market, but it is because it's a virtual public market now. And now you've moved it from the stock exchange to online when people can buy and sell and trade the tokens, which is a legal representation of their ownership.
Yep,
that's what tokenization is.
That's exactly it. It's fractionalization of assets, core propositions, fractionalization of assets, which leads to better liquidity, and digitalization of assets, which leads to faster settlement.
Okay.
So kind of two core propositions.
And uniqueness that can stand up to the test of time, but then your point on the regulatory framework around it, where it represents that the title and deed in terms of the piece of property too. So then now, so if tokenization, just using real estate, but it doesn't have to be real estate. But then you come over to stablecoins. So what's a stablecoin then? Because there's a little bit of, and again, correct me where I'm wrong, I look at stablecoin as a representation of another asset, not real estate, but of, call it a U.S. Treasury bond or the U.S. dollar itself. So what is that stablecoin asset?
Yeah, so that distinction is exactly right. So it's a form of tokenization in the same way that you're taking one thing that exists in a form and you're creating a digital representation of that thing. But the one thing you're taking, rather than a house, you're talking about something, a financial asset. When people talk about stable coins, at least this year, typically they are talking about like a currency representation as a digital asset. So a US dollar tokenized would be another way to kind of talk about a stable coin. That's effectively what it is. Did that answer your question before going into more detail?
So let's go into more detail. So why would, if it's basically represented by my dollar, so I still carry cash, right? I maybe one of the few remaining that still carries cash in their
comment.
And my card. And so if that's what a representation, why? So what, right? Then I just take out the cash out of my pocket. What advantages am I getting?
Yep.
And share a little bit more because of the global viewpoint. I mean, back to from Rwanda on the African continent up to England and your travels around the world. Sometimes, me included, we all get very U.S.-centric in thinking about how our systems run here versus thinking about it on a global basis and how this opens up markets, how this opens up cross-border, creates some challenges. Share a little bit more of that global context for listeners, because I think that's where some of this power actually comes into play, even outside our U.S. borders.
Yeah, that's exactly right. It's interesting. A lot of the questions, your point on why wouldn't I just take out cash is a completely valid point. Why don't you just take out cash? Maybe it is actually better than a stable coin for you in your context. There are others in a context that's dramatically different, where particularly earners and savers in high volatility countries, fragile states, currency corridors, who are looking for stability in terms of, forget investment assets, investment returns for a second, just stability, right? That the value today is similar to the value tomorrow, and in a lot of markets at different points in time, that's dramatically not true. So having access to something that holds some degree of stability, although of course the US dollar has gone through its own volatility this year, relative to other currencies and other markets, it might be a much better alternative to be able to have a US dollar exposure off of a paycheck or off of a business balance sheet that I'm holding than whatever maybe my local currency is. There's a massive monetary policy consideration there that's really that has really significant implications. But from the core end client standpoint, that's a really significant value, right? That the 10 US dollar equivalents today is the same as the 10 US dollar equivalent a month from now. So that's a real kind of very clear value proposition for, again, not just individuals, but businesses as well. And then the other component is efficiency. So in the US, this is true, right? Stablecoins can do things that the US dollar can do, sometimes faster. Settlement is the most obvious use case, right? If it takes, you engage in transactions, sometimes transactions settle in the bank over 3-4 days. Some countries it's 30 days, it really runs the gamut. I think everyone would agree that if they could snap their fingers, the same risks, protection, securities, if it could happen in a day or no days, they would do that. So that would be one example of a value.
So everything is measured in effectiveness and efficiency.
In my view,
how effectively you can do something and how fast can you do it in the cycle time, and it's the efficiency piece. And you can't forego the effectiveness for the sake of efficiency. But if you can get both of those, right, all the better. And that's what so much of innovation is around.
Yeah, that's right.
Is how do I do things as effectively as possible, more and more safely, but as fast as possible too. People flying, private versus sitting at the airport. People being able to communicate, right? Instead of writing a letter, can I make a phone call? I mean, just all these things over history is always going to come back to effectiveness and efficiency in those measures. But then when you end up with this, what's effectiveness when you're sitting in a third world country, right? You might be looking at your currency going, yeah, my currency is not effective at all. Now I could go online and gain access in some form or fashion to these. Now, they're not without risk. You highlighted that already, and I think it's worth repeating. Even when individuals ask, well, money markets have no risk. Well, that's not true, right? Money markets can break the buck, and you can end up with a problem, as we did back in the financial crisis. So no one should be so naive in stepping in and going, this is a no-brainer. This is easy. It's stable. And there's examples of stable coins blowing up too, right? I mean, and so, but what were the dynamics around some of those items? Where again, the caution here for everyone is always, it's like, tread lightly, go do your homework, do your research, and make sure you understand what you're getting into. So when have stable coins that are effectively stable, right, in terms of the effectiveness delivery, when has that gone wrong on people and the learnings that have come out of that?
Yeah, no, it's absolutely. I think I would just restate the same advice that you have, which is just because something's called stable doesn't mean that it's stable. Just because something's framed as risk-free doesn't mean that it's risk-free. Do your own homework, assess the fundamentals, and come to your own conclusions. If everyone did that, forget the individuals, the whole financial market would be much better off.
Yeah, correct.
So that would be a great thing. Maybe that's one good outcome from the day. If we can get everyone doing that. But yeah, I think particularly in the recent past, when stablecoins came out as a really fast-moving, fast-growing potential use case, there were firms, and still are, I think, to some degree, but to a much lesser degree, that were chasing growth without actually pursuing the fundamentals around the effectiveness. So pursuing efficiency or pursuing returns, investment returns, without actually really getting the fundamentals right. Interestingly, quite similar to, I think, when traditional financial institutions find themselves on the wrong side of history. Yeah. It's exactly the same thing. In terms of the market dynamic, if I give you a stable coin, I tell you that stable coin is worth $1, then I better be in a good position when you give me that stable coin back and ask for $1. Yeah. It's exact same fundamentals as a bank run. There are a couple of instances in the recent past where there's been a firm that's not been able to effectively redeem, offer redemption at the currency or at the value that they said that coin, that stable coin holds. When that happens, there's only one outcome, right? Which is effectively a death spiral of value. As soon as I can't redeem that $1 equivalent for $1, there's going to be a lot of people coming to me.
You're pointing the bank run in terms of everybody finding out that there's nothing left.
Yeah, exactly.
So there's still so many thoughts I've got going through my mind in terms of where we're at and time-wise, trying to encapsulate this down. But there's the protocols, there's the coins, there's the systems, there's the highways that are out there. And then there's true businesses that are evolving out of this, that are exchanges in their own right, that come into play. What are some of the other businesses that are evolving and growing and emerging from all this activity regarding the coins and the protocols themselves?
Yeah. So there's a few. So, there's more than a few. Lots of different value propositions that are being explored. One that I think everyone would say is a good thing, and the market needs it, is one thing you get with particularly public blockchains is you get the opportunity to do forensic research in a way that you can't do, and particularly in private markets, which leads to great opportunities around identifying financial crime, identifying illicit flow of funds, things like this, things that genuinely would have actually been impossible, to now having the opportunity to do work like that. So that's one, I think, that's just good for everyone, the fact that is possible in this different type of architecture, not to the exclusion of it being possible in current systems as well. Other businesses that are kind of working in the space, so the cars on the highway, I suppose, so we're not talking about Ethereum, the protocol, or Bitcoin, the protocol, are focused on kind of the same things that fintech or financial technology pre-crypto was looking at. So how can I unbundle the institution and just offer the products and services at the cheapest, highest value way? So one of these would be, for instance, automated market making. So market making is complex, and even things like IPOs. It's relatively opaque. There's some criticism around why it's opaque, and at the very least, it's expensive. There are winners and losers at the point of an IPO that I think everyone would like to get to a point where they get closer to the market pricing something prior to an event, so that you get to kind of equilibrium value. So the seller gets the value, the buyer gets the value, but there's no sort of after event of a transaction where pricing shifts dramatically, 40% up or down. So automated market making is one space where there's a lot of firms that are offering products in the market and testing the ability to do exactly that. Other forms of lending is another kind of use case that's being explored. So now that you can see my transactions history, I can make it as public to you as I want to, or actually I can make it not very public at all, but you can have some degree of information, even without seeing my private information around how I'm transacting. You might be able to do a better job assessing my credit risk than a traditional bank might. In that case, you might be able to offer me more favorable terms, while you still get more favorable returns. That's another kind of use case that's being explored. And then the stablecoin business model is also just a really compelling one as well. So if I give you a US dollar token and you give me a US dollar, if I can get the right composition in terms of the balance sheet and producing yield, but also still being able to redeem in the right ways and forms and function, that's a good business model as well.
And as I take this all in, right, because there is learning that everyone's going through, right, as this evolves, and everyone's trying to figure out what's the angle and how do I get in and how do I do X, Y, and Z. There's just the cautions too that come back, right? And I play back in the mathematical computation regarding the valuation of the number of users, and I can't help but to think about the stories of people trading penny stocks, right? Pump and dump, right? Brokers that are, pumping up and talking something and then selling on the other side of it, right, to get the value. And if it's about getting people on coins, you end up with, high profile individuals that could be pumping up whatever they're pumping up to get people onto it. And at the same time, dumping on and extracting the value for themselves. So you just never know. So there's just so much caution as it comes into this space. And in figuring out then, as we do, because we're firm believers in disruptive technology, investing, how that plays out, where the growth comes from disruptive technology, because the incumbents, no matter what, will get disrupted over time. Hopefully they're doing it themselves, they're innovating and they're figuring that out, and that gives them growth, or somebody else is going to come in and that gives then equity growth back to investors. And that investor allocation is going to be seeking out things, but it can't be just a pipe dream. It can't be something that's just smoke and mirrors. It has to be real as these technologies evolve, as tokenization allows for liquidity into illiquid assets. The opening up of, in some ways, right, that gives you a pathway towards the IPO piece, right? You went from illiquid one day to completely liquid the next. I mean, it's like this. It happens instantaneously, and that price discovery piece is near impossible until you get it.
Right.
But tokenization starts giving price discovery coming into play. Everything has risk in that aspect of it. So as you learn, and we're all learning as we go on this journey, this has been a unique and one-off type dialogue as we think about entrepreneurial legacies, their innovation, their participation, their looking at how these things come into play. What closing words of wisdom, thought, caution, all of the above would you have for listeners at this point in time? And maybe we make this an annual check-in, right? Because if long history was 8 years ago, I don't know. We got to keep checking in on where this is all going to, Hunter.
Yeah. I suppose closing thoughts. I mean, I'm learning. There's a lot of people who know a lot more about this than I do, and I have the privilege of learning from people who are light years ahead of me in terms of understanding. So I think any perspective I have, I'm giving through a foggy pane of glass, at best. But I think the things that are interesting to me as I learn more, and also trying to marry history with the future, I suppose ending where we started around looking back to look forward. I think that quote about innovation will never move slower than it is today is true. But I think the pathways of innovation are in some ways predictable. So Jensen Huang, Huang is his surname
of
NVIDIA.
Yeah.
He has this great quote around finding the right apple tree and getting under the apple tree as much as you can, and then waiting for the apple to fall, because you're never going to get it exactly right, but identifying areas and opportunities for where there can be value created.
Yeah.
And so when I think about this space, I think about internet era. I think about other sort of even in the 60s, 70s, around when credit cards were being issued in early days in the United States. There's these waves of innovation that do happen, and I think it's impossible to predict exactly the winners and the losers, but it is possible to look for opportunities where there's clear value being created. And I would say that for anyone who's looking in this space, again, it's not investment advice at all. That should be the first litmus test, which is what I said at the beginning. Break down the products and the services that are being made. Yeah. Evaluate them on the basis of their core value that's being delivered.
Yeah.
And then everything else probably is noise.
So I got one more question for you there too, and then we'll wrap. Because some people, again, I appreciate your humility and always have, right? Because we could have gone way deeper on this subject, but I said, no, we got to keep it at, let's keep it at the 101 level too, as we're going through it for individuals. So thank you for playing along with that. But there's some people out there going, no, you know what? And I'll put it in the category of cyber arrogance, crypto arrogance, hubris, where it's like, no, this is how this is all going to play out. Those people at that extreme, probably not, people that I'm working with, but there may be some people that are out there and that you encounter in terms of they're 100% absolutely sure that they know how this is all going to play out. Mm-hmm. One, what do they say? And two, because I want listeners to know who they should run away from, right? Because I don't think anybody absolutely knows anything about everything. What did the cyber arrogant say about crypto?
Yeah, I think that I appreciate that framing. And I think this is true of anything that has hype at all. When innovation comes out, and AI is another great example to point to that's totally unrelated to crypto, there's always going to be the evangelist without foundation. So I think there's a lot. I think retail investors have a lot of exposure to voices in the market that are saying there's no chance this coin or that coin is going to fall below this price ever in the future because of X, Y, and Z. I mean, that's a massive red flag from my perspective. There are more prominent public figures who just have an incredibly vested interest in a particular outcome. So rather than what they say, who says what is actually another important factor to look at.
Yeah.
And I think in the early days of crypto, which again, ancient time, 15 years ago, 25 years ago, there was a real sort of revolutionary bent, and there still is a big revolutionary bent in some components of this, which is almost anarchist, I guess, in my view. I think those are the loud minority as opposed to the more quiet or the more reserved majority. I would say pay attention to where there's real marriage between institutions that have been known for innovation, institutions that are bringing innovation, novel innovation, but actually servicing clients in the real world. To me, that seems like a safer way to get exposure, understanding of the space from a cognitive perspective.
Yeah. So in closing, and I shared this, I think, in a recent, and we'll look to Haley. I think London, you're in Cambridge, but London is like, after Chicago and New York, is our third largest listenership. It's third or fourth, and then Dallas is the other one in that order. So people do know that you actually do live in England because your X, Y, and Z finally gave everyone a little bit of a flavor.
Is that what I said?
Exactly.
I didn't even notice. Okay.
So forget the Z here in the States and bringing in the Z. Hunter, thank you so much for spending time in the studio. Listeners, a lot of information that was shared. Again, fundamentally, 101, wanted to give you a little bit of a flavor and understanding because there are so many questions that are being asked on this subject. In addition to this posting of the podcast episode, there also is the paper that we'll have posted on our website to the Insights segment. to look it up, gain a little bit of information, go back to some of the topics that we even spoke through today. If you want to continue the conversation, if you want to learn more, if you want to explore fundamentally how we approach investing in disruptive technologies and how that fits into your overall wealth management strategies, please send us an email at clearconversations@ccpwealth.com. Have a blessed day.